Welcome to Market Call. Thanks for joining us. I'm Marilla Fernandez. Matt Kacur on the show with us today. He's president of FSA Valuation Service, and he'll take your questions on North American equities. Here's how to reach us. Call toll-free 1-855-326-6266. You can email us, marketcall at bnnbloomberg.ca, and you can start sending those questions in right now. Thanks for coming in today.
Thanks for having me.
So we have the TSX hitting a record close yesterday. There's been so many, I'm kind of losing track. And then pushing past that today, is this momentum sort of courtesy of earnings season, you think?
In the TSX, probably not. In the U.S., I'd say yes. So if you want to focus on Canada for a moment, I think the tariffs were a bit of a wake-up call. And I think they're maybe not as bad as you might think at first brush or by the headlines. The headlines are pretty scary. But when you really look into it, the USMCA is still in place, and it protects about 85 to 90% of the trade we do with the U.S. anyways. So it's not as big of an effect as you might have thought, or at least I would have thought when it first came out. I was pretty scared. I thought, oh man, this is going to be tough for Canada. But they also have the agency, or Canada has agency, to start looking at better trade relations with Europe and Asia. We started shipping our LNG. I mean, I'm actually fairly bullish on Canada.
Okay, that being said, you remain cautiously optimistic, I know, and I'm wondering why cautiously.
Yeah, so that's more in the U.S., I would say, because I think they're kind of hurting themselves with these tariffs. I don't see, the point of it. It's a lot of bluster. It's a lot of policy or politics. But I think there's enough pressure that the tariffs won't be implemented in a meaningful way. So that gives me the optimistic part. The pessimistic part is I am concerned that maybe some of these tariffs will be worse. I'm not really too sure. Some of the jobs data was pretty weak.
I was going to say, they revised those numbers, and that shook people up a little bit.
Yeah, definitely. So, that's usually kind of a leading indicator that the economy might be slowing down a little bit. So those are my concerns. But I feel like, the earnings have been coming in pretty strong, especially in tech and consumer discretionary. I mean, some of the other areas not as good. Healthcare seems to keep struggling, but those two big areas are still very good.
Okay, so what data are you looking forwards to in the U.S. to either reaffirm or take away the pessimism surrounding the economy in the U.S.?
Mostly the tariffs is still the number one thing. I'm just, I've never had to analyze so much politics in my life, and I've been doing this quite a while. So I really like to see that rhetoric and the actual deals kind of get done and find out, the true impact. So that's my biggest number one. I would like to see jobs data get a little bit stronger. But I think there is some agency there, too, to lower interest rates now. I think the Feds get a bit of a green light after the last jobs data to lower the interest rates, which will kind of mitigate that issue. So that's kind of how I feel.
Got it. Okay, let's line up some questions and some phone calls, emails for Matt Kacur. He's with FSA Valuation Service, taking your questions today on North American equities. We'll put the boards up so you know how to reach us. We're back in a moment. Stay tuned. Welcome back. We are going to start with an email today for Matt. The email's from Kirby. He says, can you please give your outlook on AstraZeneca? They seem to be having significant success with some of their latest research results. A lot of the pharma companies have been pushed down quite a bit over the last sort of 6 months to a year. And I guess the next push seems to be for cancer drugs, where we're expecting to see success. What is AstraZeneca looking towards pushing out that could be good for them?
Yeah, it's a great question. Now, I have to say, we're a fundamental quant shop, and then we look at kind of the story kind of on the back end. Okay. So, our strength is really the fundamentals in the financial statements, the accounting, and trying to unwind, what's really going on in that method or that area. So I don't want to say anything that I don't really know about in terms of their product pipeline. I do know, of course, that they're in oncology and cancer research. But what I can say with quite a bit of confidence is they're improving their fundamentals pretty much really since, I have here since 2017 or 2018. Is when they really started to turn this around, and I see the return on capital at 6%. It's marched all the way up to 13%, very consistently. Like, I mean, that's a 7-year cycle of improving. I still have pretty good valuation. Let's see the multiple here. I have 13 times EV/EBITDA, which is very reasonable. So you got an improving company. Let's assume the pipeline is the reason for that. And, it's a well-run company. I have a lot of good things.
I guess a lot of people, if they had bought in 2024, when it was sort of closing in on the $90 there, are concerned, right? They've seen that drop off. Would you buy in at this point, I guess, considering, as you say, the numbers look good? Yeah,
I would. Again, one of our biggest indicators is improving return on invested capital, and we've been seeing that. So, a couple of years, maybe they have some weak trading, but when the fundamentals are there, you just got to wait it out. I mean, so I don't get too hung up on a weak couple of years.
All right, let's go to the phone lines then. We have John on the line with a question. He's in London, Ontario. Hi, John.
Thank you, Marilla. Dzień dobry, pan Kacur. My question is on Shopify. I seem to recall buying a small position at around $60. Now, it's had a huge report, and it's done very well, unlike its counterpart, Amazon, in the U.S. recently. What do you think about Shopify for maybe an add and a hold for 2 to 3 years? Thanks very much.
Okay, so Shopify reported its earnings are up 31% to $906 million in the latest quarter. Profits up that much. It was $171 million US to compare for last year. So it's done really well and benefiting from AI. I know you're looking more at the numbers. What do you see?
Yeah, so this is a really tough one for us because it really doesn't have, there's a lot of spec in it, let's put it that way. I think that's the best way to say it. That doesn't mean it can't be successful, but if you looked at this from a pure quantitative, what have they posted, what are their results, you'd be a little bit nervous. It's just not quite there. Now, it is in that, still I'm gonna call it a startup. I know it's been around for quite a while, but it's still in that high growth, ramping up its operations, and it is improving their return on capital, which we love. Where it really starts to get a little nervous for us is the valuation. So for me, if you're going to own something like this, I don't have a problem with that, but should not be considered core, I would say. I think that's fair. So if you normally have, let's say, 20 stocks, that'd be 5% each. I would take this one down about 2, because I just think the risk is there when you're in this high growth, early stage, can be really exciting, can get the job done, but there's a lot of risk in that phase.
So in this current momentum from the earnings report we just referenced, might be a good point to trim if you're looking to trim?
Yeah, I would probably do that. We had a big pop today, so yeah, I might take a little off the table, keep that weighting kind of in that spec weighting kind of thing. So yeah, I think that's a fair comment.
Got it. Okay, let's go back to the phone lines. Frida is on the line. She's calling today from Chilliwack, BC. Hi, Frida.
Hi there. I'm interested in Enbridge with its high dividend. And is this a good time to buy in? Thank you.
Okay, that's a question for Enbridge. We'll pull up that line chart in a moment. People do buy Enbridge just for the dividend and sort of just take that money and run. The stock has done pretty well. It's wavered, though, sort of the last few months up to 64.56, but a pretty dependable company.
Exactly. I think, you should be sitting on this side of the table because this is exactly what I would have said. This is the kind of stock everybody can own. It is consistent. It is reliable. It's a pseudo utility. It actually falls under energy, but I consider it a utility. The results are always consistent. It's not a high return on capital because there's a lot of capital in that kind of business, very capital intensive, but it is so consistent. The dividend is, I think, quite safe. Our dividend chart looks fantastic. We compare it to the payout ratio too, and everything looks really good there. So that to me is a long-term buy and hold. You should buy this just consistently. Like dollar cost average your way in on that one. It's a good one.
So you mentioned it's a good dividend, and people are looking for growth, right? Especially if they're going to buy in at this point, which is a pretty high point. You're saying sort of dip in, take it in tranches. Do you expect much growth from this company, considering the emphasis on energy these days by the North American governments?
Well, no, I wouldn't expect a lot of growth. It's just not the nature of the company. They sometimes make some acquisitions, which gives them, bought growth. They buy that growth. But in their operations, no, it's just not the way it's going to be. It's going to be, 4, 5, 6%. You can get better pricing, some things like that. But no, it's consistent. It's a dividend stocks generally aren't high growth stocks.
Okay, so it's a steadier stock moving forward. Okay, we're going to take a quick break. Matt Kacur is sticking around. He's with FSA Valuation Service. He's taking your questions on North American equities. Here again is how to reach us: 1-855-326-6266. We're back in a moment. Stay tuned. Welcome back. Thanks for joining us here on Market Call. Matt Kacur is with us today to answer your questions. Let's go to the phone lines. Walter's on the line from Ottawa today. Hi, Walter.
Hi. Thank you for taking my call. My question's on Visa and MasterCard. They're pretty much the same, but more Visa. I noticed the last 3 to 4 months it's been struggling. I've been a long-time shareholder of Visa, over 12 years now, and I'm just wondering why it's struggling. It's had an incredible earnings report last week, topping estimates, both top and bottom line. And I'd like your opinion. Would you buy it at this level? Thank you.
Okay, thank you for the question, Walter. Do you see any obvious reason for Visa to be struggling?
Yeah, I think it's the stable coin. Which is tied to the U.S. dollar. If this can be manifested into an efficient system, it's efficient in that there's very low transaction fee with stablecoin, if any. That might be zero. I'm not an expert in stablecoin, but that's the rhetoric that definitely comes up with Visa, and that could be a threat to their business. When you pay for Visa now, the stores pay a 3% transaction fee. If they can lower that with their stablecoin kind of platform, they're going to look into that. Now, Visa also has an ability to kind of change their fees, maybe set up their own kind of stablecoin. So I'm not too concerned. In terms of payments, Visa's my favorite. I like MasterCard as well. They're almost half a dozen one way, 6 another. But we've always owned Visa. We've probably owned it for a decade or so. And I think this is more or less noise around stablecoin. But that is the reason, I think. Would you dip in even more at this point? It has dipped, so it might be a good time to buy. Would you suggest that? Yeah, in terms of dip, I have it only down 8% off its 52-week high. That's also some normal trading, right? That happens to any stock at any time. We got it down 3% this week. It's as good as time as any. Got it. Let's go back to the phone lines. Dave's on the line today from St. Catharines, Ontario. Hi, Dave.
Hi, I'd like to thank you for taking my call. Matt, I'd like to ask you about Royal Bank and where you see it going in the next year or so. Would appreciate it. Thank you very much. Okay. Bye-bye.
Thank you for the question. Royal Bank, consistently high performer, right? Always pushes past. It's at 181 today, which is pretty high. It's pushing around 180 earlier. So, solid bank. Again, yeah. There's no red flags here. Royal Bank, to me, in fact, if I screened every single bank, Canada, U.S., I think Royal Bank would be number 1 or number 2 in our work. It's so consistent. It's so efficient. They just do the right things over and over. The numbers come out fantastic every quarter. It's a long-term buy and hold. I have no
have nothing even cautionary about it. So it's a long, get that in your portfolio and forget about it.
And it's got a decent dividend as well. You think that, is it like Enbridge where the growth might not be spectacular, but there will be growth?
I think it would have more growth than Enbridge, so I think it's better in that regard. I'm looking at our dividend chart, which it seems like they raise it actually every 6 months they've been doing it. The cash flow to support that has actually been climbing the last 4 quarters. The payout ratio, the way we calculate it, which is a little different than most, but it's 41%. It's very reasonable. Again, I'm looking for the red flags. Almost always a red flag in every single one. It's really hard to find one for a Royal Bank.
Got it. Let's go back to the phone lines. Joe is online from Montreal with a question. Hi, Joe.
I want to ask you guys about ARC Resources. I've had it for more than a decade, and I just heard the other day an analyst mentioning that in the U.S., of course, that's part of Trump's drill, baby, drill, that they're going to be increasing gas production. And I just wanted to ask, would this affect the long-term view for ARC Resources and their LNG projects and the benefits for them for that?
Okay, thanks for the question, Joe. ARC Resources, many are putting money in this sector of natural gas because they do expect some exports to other markets. But if the U.S. is going into natural gas in a big way, I mean, how would we stack up in Canada, and would that take a hit, or would our natural gas market take a hit?
I'm not really sure how the dynamics will play out with the U.S., but I can say this. ARC is one of the top beneficiaries of the LNG market. We just started shipping that overseas. I think that's just going to grow over time. The numbers that I have here, which we rely on more than the stories, I see an improving return on capital the last couple of quarters. Valuation doesn't worry me too much. I have it at 6.4 times EV/EBITDA. So in terms of, if you're a believer in LNG, ARC is your name, your go-to name probably. And
don't worry about the fluctuations that are more recent, which have been sort of during the summer.
Yeah, I mean, I have, what do I have for a 3-year CAGR, 17%, a 1-year return of 21%. That includes the dividend. You do get a 2.7% dividend yield. Let me check the chart there with a low payout ratio and a growing dividend. Another really good question, good stock.
Got it. Let's go back to the phone lines for Bill. He's calling from Bowmanville, Ontario. Hi, Bill.
Hi. Thank you for taking my call. I'd like your guest's opinion on Comfort Systems. It's done very well, and I'd like any comment he has on it. Thank you.
Okay, thank you for the question. Comfort Systems, can you tell me about them?
I can. I think the ticker's fixed. I'm just going to run that.
Sure.
So I know in general the HVAC has been very good. It's been an excellent area to be in. And that's partly because of the build-out of data centers that need cooling.
Sure.
Now, obviously, buildings need cooling and everything else, so it's not just that. But it's a really great space, and Comfort is definitely one of the top ones in there. Looks great in our model. I see improving return on capital, growing their capital. I see pretty reasonable value from the way we do it, which is a modified discounted cash flow. A little bit higher on EV/EBITDA, 23 times, but given that it looks okay in our discounted cash flow, I'm bullish on that. That's a very nice profile in our work.
Got it. Okay, Matt has not been around in a while, so we have no past picks to come back to, but we are going to talk some more about the AI build-out and the needs around that from energy. So we'll talk about that in a moment. Stay tuned. Welcome back. All the talk, of course, is AI and how it can benefit companies and investors. One angle Matt has been looking into is energy and the amount of energy it'll take to fuel this boom. First, Matt, can you sort of explain a little bit about the kind of energy demand just from the build out of AI alone?
Yeah, it's tremendous. Well, first of all, the grid itself is kind of not built up enough, regardless. And the the building of these data centers is huge, and it's a whole other, layer of energy that we're going to need. So I've been finding companies kind of in that space, electrification of everything, building out the data centers, that kind of thing. And I find a number of companies that I'm really quite attracted to. So Eaton is one example. Vertiv, VRT, I think is the ticker on that one. They specifically design theirs for data centers. So it's not just, it was a great call. We just had a great segue with comfort, because that's all part of it too. HVAC, keeping these things cool. You saw, I think it was Meta, did a huge deal with Constellation, right? Mm-hmm. You don't really see a company like Meta making a deal with an energy company like that.
But we're beginning to see more of that.
Right. That's how big this area is to me. And there's a number of good companies too. There's some spec ones that are there that I have a little bit more trouble with because we're a quant shop, but I think it's happening is, nuclear is bubbling up, and there's probably some opportunities there. Unfortunately for us, we just can't find the right ones, but I do think there's some opportunities there. Yeah.
Okay, I want to pull out a couple of different things, because you mentioned some of the companies you're beginning to look at. Are there companies that are sort of just taking their do HVAC, for example, and then you say now perhaps getting into the data centers and the needs of that? Those are existing companies. Are there companies that are just starting up just to fuel the energy needs of AI?
Well, I would say Vertiv is a perfect example. I mean, literally cooling systems for the computers and for the rooms themselves. I think that's a perfect example of, and they've already posted fantastic results too, because often in the early stage, you're ramping up, you don't quite have the cash flow and the revenue, but there's a vision that it would happen. I don't have a lot of early stage ones like that, but I do like that Vertiv. Some other ones that are good engineering firms, like MCOR is another one, EME. That's benefiting from this build. Like Amphenol is another one. But these are more existing ones. So your question was a little bit on the, what are the new startup ones? The only one I really have that I'm confident in is Vertiv.
Okay, and we're seeing all different kinds of energy sources, right? Mm-hmm. Because you first touched on electrification, but uranium is going to be a big thing for nuclear reactor build out. What else are you seeing? Yeah,
so as part of this was my premise is the infrastructure as well. So I'm going to kind of go a little different away from your question, but a good beneficiary is Broadcom. Okay, Broadcom, they don't make the brain chips, like the chip that does the calculations. They make the chips that move the data. So there's one that would benefit. Marvell is another one that moves data, like the efficiency and low latency. Broadcom has been doing phenomenally well, and that's all about the build out of the data center and the infrastructure. Just
in your opinion, are we falling behind in the energy needs for these build outs? Are we keeping up? How would you qualify?
Yeah, I do think we are behind. That's true. And that's why you see these uranium stocks doing really well. I wish I had a good uranium idea for you. They just don't. They're all really early for us.
Cameco is one people talk about,
Cameco's
which is established. Yeah.
Exactly. It's a nice company. Doesn't screen particularly well. But the future seems like, that's going to go there. So that's why investors have bid that up.
Got it. Okay, Matt Kacur sticking around to take more of your questions after a break. He's with FSA Valuation Service. He's taking your questions on North American equities. Back in a moment. Welcome back. Thanks for joining us. Let's go right to the phone lines. Ray is on the line. He's in Collingwood, Ontario. Hi, Ray.
Hi, thanks for taking my call. I'm actually calling on behalf of my son, Topher. He's has trouble with these kind of things, so I'm just going to ask the question that he has. He's 19 years old. He's been following CNR ever since he started trading on his birthday. He did an initial buy-in. He bought a couple times since, and now CNR has finally hit below what he had set an alert for to put in a substantial amount of money, like around $4,000 to $5,000 for him. That's a lot, and this is for a lifetime, most likely. So it's one of his core holdings that he's been following here for a while and trying to get in. and he's kind of wondering if maybe this might be a good time and why maybe CNR has taken such a big hit in the last little while.
Okay, thank you for the question on behalf of, I guess, your son. CN Rail and some of the rail lines would have been hit by tariffs, right? Things going back and forth. Is there something more at play here?
Yeah, I'm not sure exactly why. Again, we focus on numbers first and then stories second, but I got a good handle on these numbers right here. And I can see why the stock has been down. Just for instance, let's just go to the revenue line. And this is the revenue growth quarter over quarter, or so I should say same quarter of the previous year. So here's the last four. 2.7% growth, minus 2.8% growth, 3.6%, and then minus 1.5. That is not inspirational. The margins are okay, but you see there's very little growth. In fact, could be zero if you kind of netted that out, those different quarters. The return on capital is slipping a little bit. I'm not particularly, long term this is fine. You know, if you want to put that money away and forget about it, you're going to be fine. I don't think I would be entering at this point. We find what we look for in kind of a turnaround like this, we want to see that return on capital actually start to move back up. And you're probably going to need more like 5% to 8% revenue growth to see that happen. And I do not think you need to do it ahead of the quarter. We've had success waiting for the quarter to be reported and then seeing the results. And then, okay, you might miss that first day where it gets a little pop, but it's worth it because, it could go down for the next 3 months before that even happens.
Got it. Okay, let's go back to the phone lines. Kevin is calling from Kingston, Ontario. Hi, Kevin.
Hi, your opinion on TD Bank, buy, sell, or hold? Thank you.
Okay, so TD Bank has done a pretty good job of climbing back after what happened sort of the fall of last year. They got had to hit a penalty out of the U.S. and had an asset cap in the U.S. as well. So it's done a pretty good job when you look sort of from the end of last year moving forward, except for that April dip. They've moved steadily up and been hovering lately around $100. And people who have benefited from this move up are kind of thinking, okay, is there room to move? Can I benefit a bit more? Or has it sort of flattened out the way we've seen it? Will that continue?
I think it can go higher. I mean, I don't know what they were thinking when they made those mistakes. That was really weird. And it did present an opportunity because, TD does not have a reputation of doing these sorts of things. So I think, they're back on track. I think it's a great buy and hold. It's in that same category as Royal Bank. The great thing about Canadian banks is they're all really good. It's hard to go wrong with any of them. I still think TD it hasn't fully recovered, I'm going to say, from that. There's still doubt, I would say. Some people are still nervous. So I think as they mitigate that problem or get past it further and further and it's more and more in the rearview mirror, people will start bidding the shares up even higher. So I think it's still very good.
And just to fill people in on what happened is they got a slap on the wrist because they didn't oversee money laundering efforts properly, I guess. Or that was lax in the U.S., so they had a big, significant penalty they had to pay, as well as sort of selling off some of their American assets. Okay, let's go back to the phone line. Renata's on the line from Oakville, Ontario. Hi, Renata.
Hi, good afternoon. I would like your opinion on TELUS, please. I'm at the moment in the red, and my question is buy, sell, or hold. I hang up and look for your opinion. Thank you so much.
Okay, thank you for the question. TELUS, one of the telecommunications companies, which have been looking to find other revenue, other ways to diversify and bring back the bottom line. What do you think about TELUS?
Yeah, it's kind of mixed, I'm going to say. It does have, I have a 7.2% dividend yield and a payout ratio of 43%. Cash flow has ticked up a little bit. So those are the good news. And I think you're definitely safe with the dividend. I feel pretty confident about that. Don't love the valuation here. Don't love the growth profile. I know it's supposed to be a low growth, but it's really low, about 2%. I'd like to see that go back to 5%. So how do I answer the question? I think if I owned it, I would hold it. I don't think I'd be buying any more. And I would just be collecting that dividend and not expecting much more than that.
Got it. Okay, let's go back to the phone lines. Bruce on the line from Simcoe, Ontario, with a question today. Hi, Bruce.
Hello, and thank you for taking my call. My question would be on Merck. It seems like the only people that are making money on it for the past year are the short sellers. I just wondering when it's going to make a comeback.
Okay, let's have a look at Merck. We talked a little bit about the sector early on, and it's been pretty sluggish. When you look at the numbers for Merck, what do you see?
Yeah, well, first of all, this whole sector's been problematic. So I wonder if it's just getting caught up in the healthcare downdraft there, because fundamentally it actually looks pretty good. So it kind of looks like an opportunity. I see return on capital last 4 years, 7%, 9%, 9%, 10%, 11%. That's in the trailing 4 quarters. There's nothing wrong with those numbers. That's really good. They got a pretty clean balance sheet, not too much debt, decent working capital position. Let me check on the revenue growth. Revenue growth last quarter was down 1.6, but previous to that, 6.8, running around the 6 to 7%. To be honest, it looks more like an opportunity to me than anything else. And let's comment on the dividend. We have a 3.9. Oh, dividend chart looks great. They keep bumping up the dividend once a year, and the cash flow to support that and the dividend payout ratio is really healthy. So it's probably just getting caught in the downdraft of healthcare.
Got it. Okay, let's go to an email from Greg. Greg says, I'm interested in your thoughts on Blackstone and if you would hold or sell at this time. We'll pull up that chart and take a look at where Blackstone is. What do you think of Blackstone?
Yeah, interesting. And I find it interesting how he phrased this question. It's not a buy, hold, or sell. It's a sell or a hold. No mention of buy. So I guess you own it and you're looking to maybe exit now or soon. And for me, I'm surprised at this because Blackstone is the #1 company in this space. It's private equity, alternative investments, and it's a monster. It's the biggest one in the space. What surprises me is how inconsistent the results are. Now, I suppose that's the nature of the business, being in that private equity kind of space. And it's also I kind of find it ironic that you can play a public company to buy private companies, but that's okay. So this is a long, convoluted answer here. I personally wouldn't own it. It's too volatile for me. The results are too inconsistent. However, in a portfolio, this makes a lot of sense. It gives you the exposure to the private equity alternative investment. Now, if you have 10 stocks, this should not be one of your core 10. I fully support it, though, as a bigger portfolio and a piece of your portfolio. And
his question of holding or selling, would you hang on then?
If I owned it, I would hold it. I would hold it.
All right. We are going to take a quick break. Matt is sticking around. We're back in a moment. Stay tuned. Welcome back. Matt Kacur here with us to answer your questions. We're going to Garish on the line from Oakville, Ontario. Hi, Garish.
Hi there. My question is about Go Easy, and as they declare their results today, what is your recommendation? Buy, hold, sell?
Okay.
Thank you.
Thank you for the question. We'll have a look at Go Easy. Right now, it's at 187.08, a little bit up today, third of a percentage point. So again, 187.08 up about 60 cents.
Mm-hmm. I like Go Easy. I think it makes a lot of sense as part of a portfolio. I don't think I'd have this as core. I'd rather have a Royal Bank and a TD or something like that. Big financial. But this is a financial kind of niche company. So if you have kind of a portfolio of 20 to 30 stocks, this could make some sense in there. I think the results are really good. I think the recent results are even better. So I'd say it's on a bit of an upswing as well. So yeah, I'm pretty comfortable with the name. Yeah, I like it.
Got it. Okay, let's go to the phone lines. Paul on the line in Toronto with a question. Hi, Paul. What's your question today?
My question is about Wynn Resorts. in the casino space. What Matt thinks over the next 3 to 5 years with China and their expansion into Al Marjan.
Okay, thank you for the question. We haven't talked about sort of hotels and casinos. That's a new one we don't talk about a lot. So what is your take on Wynn specifically?
Yeah, give me one moment to run. Yeah, okay. I would like to be more positive, but I have to call it as I see it. I call balls and strikes here. The results aren't particularly good. They have gotten a little bit better over the last 3 years, but I only see a return of 5.3% on their capital. I don't love their balance sheet. You got a 1-to-1 debt-to-equity ratio. So that kind of makes me nervous. Let's check on the growth. There could be some growth here that at least we don't even see a lot of growth. We see 8.7% decline in revenue. So you're really playing this for the opportunity, overseas, I think. And that's too much spec for me. So to me, this is just way too risky.
Got it. Okay. I hope that helps you make some decisions, Paul, as we move on to Terry from Vancouver with a question. Hi, Terry.
Good morning. Thank you for taking my call. I'm interested in Pembina Pipeline and whether it's a time to add to my position or sell a bit or just hold as is. Thank you very much.
Okay, thank you for the question. Let's pull the chart up for Pembina Pipeline. We get a lot of questions about Pembina. Again, people bullish on the energy sector want to get in on something here. It's trading today down a little bit at $50 at 61 cents. Will Pembina benefit from the energy boom that's expected, not only with AI build-out, but just generally?
Yeah, I think so. I own this one in our portfolios. It's been very good for us over the years. Yeah, the last year, maybe not the best.
How long have you held it, roughly?
At least 5 years.
Okay.
I think somewhere around the pandemic, we got back into it. It's always been a good one. I love that it's improving its return on capital. It used to be around 5 or 6% return on capital. I remember this is a kind of utility, so we expect low returns. But it's actually up to 9%. So for a utility, that's actually pretty good. It's improving its return. The valuation's very palatable. 11 times EV/EBITDA looks even better in our discounted cash flow model. And we talked at the top of the show, why is Canada doing well and the market is doing well. I think this one kind of fits into that theme. So yeah, I would buy more if you could.
What's the drag on the stock? It took that dip in April like everything else did, but it's still quite down from probably when you bought it 4 or 5 years ago in the pandemic. I'm just wondering what the downward slide, what do you attribute that to?
Yeah, I don't know. I'm not 100% sure. There was a bit of a spike when the tariff talk really ramped up, and then it's kind of died down. So maybe it was a little bit of just an overhype in the first place. I don't really see any particular reason why it would be down at this point. It could just be normal trading. I don't really have a great answer for why it's down. It just looks good to us fundamentally.
So you still buy in at this point?
I would.
Got it. All right. Let's go to Todd. He's in Niagara Falls with a question. Hi, Todd.
Hey there. Just looking for our guest's opinion on United Healthcare and if there's somewhere else you'd rather invest right now.
Okay.
Thank you.
Thank you for the question. Big player in health insurance in the U.S., but sort of guessed wrong on numbers coming in, and there are other headwinds for the company as well. People have been waiting for this stock to bounce back, right? They're like, it's a big player, it has to bounce back, and it really hasn't yet. Take a look at the numbers and...
Well, the numbers are fantastic, so there's nothing wrong with the numbers. It's there's potential fraud here. So they were...
there's an investigation.
There's an investigation on defrauding Medicaid and Medicare. So you cannot quantify something like that, unfortunately. If you just looked at the numbers, you'd be like, oh, wow, this is fantastic. It's great. I don't know how to quantify that kind of risk, that kind of fraud. So for me, I just, when I don't know, I have to step aside. I mean, there's enough risk in everything, in the stock market. You could buy the perfect company, you could buy the Royal Bank, which we basically had nothing bad to say about it, and that could go down 10%. So why do you want to take on a risk when there's potential fraud here? I don't think it's just not worth getting in now. When that maybe lifts, and maybe there's some resolution of that, yeah, the stock's going to go up, and you might miss 15% upside for the day, but at the time it's still, it's down 56% for the year. I don't see why it would rebound without a resolution. So I'm willing to miss a little bit of that upside.
To wait for the resolution.
Yes.
Got it. Okay. That is all the time we have for phone calls and emails. But stay tuned. Matt's going to share his top picks after the break. Back in a moment. Join us tomorrow for Market Call. Bruce Murray will be on the show. He's CEO and CIO from Murray Wealth Group. He's going to take your questions on global equities. And time now for Matt's new top picks. We're going to start with one he's already mentioned today, Amphenol on the New York Stock Exchange. They manufacture sort of the things that connect us, I'll put it that way. But if you can expand on that.
Yeah, so I would say think of electronic equipment that needs sensors, needs antennas, sensing the temperature, sensing the wind direction, a little bit of a description here, interconnected, fiber optic, circuit boards, switches, those kinds of things. In aerospace, the buildup of the, we talked about the buildup of the data centers and the energy, like this would be right in that space. This is a perfect one for that theme that we really like.
It's got a high valuation, right? It's 27 times, which normally would make you think twice, but you don't mind that.
Yeah. It's not perfect, and it certainly has run up, quite a bit. In the last 6 months, I have up 57%. So that I would say that's one thing. Let's kind of get in a better trading position. But we don't really trade; we just buy great companies. So yeah, 27% or 27 times EV/EBITDA is a little high. However, in our models, we do this thing called beat the fade, right? So companies tend to fade over time, right? Competition comes in, drives down rates of return. It's just a normal economic thing. This company has proven not to fade for a very long time now. And I don't think, given the position they're in, I don't think they will fade. When we say fade, revenue is going to drop off, return on capital would drop off. I just don't see why, given what they do, and given their track record, why they would fade. So I'm going to say, yeah, I'm willing to pay up 27 times for a company of this quality.
Got it.
So I would say that.
Okay, let's go to your next pick, which is CBOE Global on the NASDAQ. You're going to have to explain this company, what they do, and why you like it.
Well, it's a exchange for stocks, ETFs, and crypto. So it's like the New York Stock Exchange. It's like the NASDAQ. It's just a little bit smaller. They focus on derivatives. It's still a $26 billion market cap, by the way. The return on capital profile's phenomenal, off the chart kind of return.
How long have they been around, roughly?
Oh, my goodness. Let's see. I have them a public company back in 2008.
Okay. So they've been around a while. Why do you like them specifically?
Well, I like that space in general. So, the Toronto Stock Exchange is a stock as well. You can buy the Toronto Stock Exchange. That's a great stock, actually. ICE is another one, Intercontinental Exchange, which is the one that bought the New York Stock Exchange. That's a great company. NASDAQ, you can buy the NASDAQ as a stock, not the NASDAQ basket of stocks, but the actual NASDAQ operating company. They're all fantastic. So I thought, okay, I like them all. So let's just put that out there. Maybe that should be an ETF in itself. And this is actually probably the smallest one. Well, probably Toronto Stock Exchange would be smaller, but this one's a little more exciting.
What's the stock at for this?
I have it at $248. That's 19 times EV/EBITDA. It's got a great chart. CBOE is the ticker, so someone can pull that up. Just steadily moves up and to the right. Nice little dividend. It's only 1%. Let's see the growth here. 20% growth in the last quarter. One last little thing on it. They also have opened up trading on crypto, so it's kind of the leading exchange for crypto at the moment.
Got it. Okay, let's get to your third pick, which is a well-known name, Microsoft.
Yeah.
Also reporting it's doing well with Azure, and how's it doing with Copilot? Is that one of the reasons you like it?
I mean, I like it. I've liked it long before Copilot. I think it's an interesting development in the company. I like the product. I use Copilot quite a bit myself. But it's just the consistency this company produces as revenue. Like everything they do is recurring revenue. 18% revenue growth for one of the largest companies on the planet. I just think it's the best recurring revenue model ever built. It's an incredible business.
When you compare to the other Mag 7, is it your favorite?
I think it is my favorite. I mean, I've owned this for 2 decades, I think, personally. And I just love the recurring revenue. I love that they're on the leading edge of everything, you know, AI, cloud, as we mentioned, Copilot. I mean, the product suite's unbelievable. The Office suite, like you can't live in the business world without Office. And it's just unbelievable recurring revenue, stock repurchases.
It rings all the bells.
I mean, it's
Okay.
just so good.
Got it. All right, we do have to leave it there, Matt. Thanks for coming in. Appreciate seeing you, and thank you very much for watching Market Call. We'll see you again tomorrow.